Hi everybody, my name is Mishkin Santan. I'm an International Tax Director with the Wolf Group. Today I'm going to be talking about the Tax Cuts and Jobs Act and how it has changed the domestic corporate tax code. In particular, there are 4 big changes that I will talk to you about today. The first big change is in the international corporate tax rate itself. Under the old law, it was under a graduated rate system with a maximum rate of 35%. Under the new law, it's now a flat rate of 21%. That's right, a flat rate circa Ross Perot 1992. Second, as Phil Keegan from The Amazing Race would say, the corporate alternative minimum tax has been eliminated. Say goodbye to Form 4626. It is no longer applicable. Third, net operating losses are now limited to 80% and can no longer be carried backwards, but they can be carried forward indefinitely. Finally, in a big blow to all those folks that are Bitcoin traders, 1031 exchanges are no longer allowed for personal property and are only allowed for real property. So for those folks that were doing tax-deferred exchanges for Bitcoins prior to the end of 2017, you can no longer do those starting Jan 1, 2018. The Tax Cuts and Jobs Act changed the International Corporate Tax Code, but unlike the domestic corporate tax code, it didn't make it simpler, it made it more complex. Today I will talk about the 4 biggest changes to the International Tax Code, but before I do that, let me speak about individuals. Individual expatriates that have a U.S. tax filing requirement still have that filing requirement, and you still have to report under FATCA. That means if you've previously filed Form 1040 and the FBAR, you need to continue to do so in addition to any other international informational reports such as Form 5471, Form 3520, and Form 8938. The first big change to the International Tax Code involves multinational corporations. And when I say multinational, I want you to think about corporations like Apple and Google. Basically, we're talking about corporations that have a domestic C Corp with some kind of foreign offshore subsidiary. These types of corporations will now have access to what some people are calling territorial taxation. However, the term used for this by Congress is called the Participation Exemption System Taxation, or PEST. That's right, PEST. PEST involves receiving 100% dividends received deduction from foreign source dividends. This is great for those multinational companies, but it's really bad for individuals that are owners of controlled foreign corporations that do not have a C Corp or an S Corp at the top of their structure. Why is this the case? Because they don't get the 100% dividends received deduction. That takes me to the second big change, which is called the transition tax. Some people are referring to this as the repatriation tax, and the Big Four call it the toll charge. Captain Kirk shields up red alert here is that this toll charge is due with the 2017 tax return. What this tax does is it allows you to catch up on taxation of deferred earnings. Under the old law of taxation, you could defer offshore earnings until you were ready to bring it back under a dividend, as long as you didn't violate any of the Subpart F rules. Under this new law, you have to bring back all of those earnings and pay the repatriation tax on them. You can then transition over to PEST if you have this multinational setup. If you don't have the multinational setup, well, then you don't really transition to PEST now, do you? What do you transition to? Well, that takes me to our third point. The third big change is called GILTI. That's right, folks, GILTI. Global Intangible Low-Taxed Income. Do not let the intangible part fool you. The best way to think about this is that if you have operations overseas, those operations will be taxed if you're in a low-tax jurisdiction. That's what GILTI does. It taxes the operational income for those people that are operating in low-tax jurisdictions. What is low tax? Because our new domestic corporate tax took a page out of Ross Perot's playbook and is now 21%, think of a low tax as 90% of 21% or 18.9%. So if you're in a jurisdiction that's less than 18.9% corporate tax rate and you're operating there, you may be subject to GILTI. Such jurisdictions are Ireland, Canada, Liechtenstein, or Hong Kong. Also, you have to consider that the Subpart F rules are still around. They didn't go anywhere. So to summarize, individuals that are owners of closely held foreign corporations will be subject to the repatriation tax in their 2017 tax return. Then they will transition back to the old law under Subpart F plus GILTI. But wait, there's more. In their infinite wisdom, Congress decided that they needed more taxpayers in the tax base. What does this mean? If you expand the base, then you have more people paying taxes, which means more revenue. You get the point. In order to do this, the best way to do it would be to change definitions. And in this case, Congress changed the definition of a U.S. shareholder. Under the old law, a U.S. shareholder was anyone that had 10% or more of the voting power of a foreign corporation. Under the new law, the definition has now changed to be a 10% owner of value. So in the past, people would own big chunks of value of foreign corporations but not be considered U.S. shareholders because they had no voting power. But now those same people would be considered U.S. shareholders and thus may be subject to the repatriation tax, subpart F, or forward planning under GILTI. Yes, you might feel a little bit like Luke Skywalker at the end of The Empire Strikes Back, but there is hope. The repatriation tax can be paid back over an 8-year period, and I'm sure the regulations will eliminate IRC 7872. We also have the ability to still make 962 elections, and of course, there is tax planning. Just like when Subpart F came out in the 1960s, you can plan around GILTI so that you are not guilty. And remember, everyone's facts and circumstances are different. You shouldn't rely upon this material, but rather investigate it on your own. And when in doubt, always hire a qualified tax professional to analyze your facts and circumstances and provide guidance. How do I know if my foreign corporation is going to be subject to the repatriation tax? Well, that's a great question. You kind of have to walk through the analysis a little bit. So first off, you have to understand and know whether or not your foreign corporation is what we call a deferred foreign income corporation, or a DFIC. And I know it's an acronym, and a lot of people think IRS loves acronyms, but that's actually right from the statute, so it's actually Congress that loves acronyms. But a DFIC basically is a combination of two things. One is what we call a specified foreign corporation, which is now, once again, one of two things. It's either a controlled foreign corporation or it's a non-controlled foreign corporation where you have both a U.S. shareholder and a domestic C Corp that's a shareholder, okay? So if you're in one of those two scenarios and you have what we call retained earnings, which is basically accumulated earnings and profits, then you are a DFIC, and then you will be subject to the repatriation tax. Okay, second question. How much is the repatriation tax? It's a good question. So once again, you have to look at your retained earnings, and you basically have to break them down between cash and non-cash. And basically what happens is that cash is taxed at 15.5% and non-cash is taxed at 8%. So third question, what dates are we looking for in regards to measuring cash versus non-cash? That's a tricky one because there's a lot of different dates within the statute. Typically what I tell my clients is I'm going to need your financials, and by financials, profit and loss balance sheet, basically to determine the retained earnings as of 4 separate dates: December 31st, 2015, December 31st, 2016, November 2nd, 2017, which that's a key date. November 2nd would be the date that the House came out with its version of the legislation for the new bill, and then December 31st, 2017. So we look at all 4 dates for measurement purposes. There's a formula for how to measure for each date, and then whichever combination of the dates has the highest amount is the amount that you use. Fourth question, installment plan. What is the installment plan? The installment plan is a no-interest installment plan, so that means you're not paying any interest on it. It's payable over 8 years beginning in 2017, and so for the first 5 years, you just pay 8% of the total tax due, and then for each additional year, it kind of goes up from there. So I believe in year 6, it's 15%, year 7, it's 20%, and year 8, it's 25%, so it's backloaded, if you will. And one thing to note on the installment plan is that that first payment, you probably want to make that payment on or before April 17th, 2018. That's pretty critical for 2 reasons. One is estimated penalties in regards to tax payments, but number 2 is, technically under the rules, if you don't make your payments timely, you can trigger what's called an acceleration clause in the payment plan structure, which would accelerate all the payments into one immediately. I'm sure that regulations will come out to help alleviate the timing of when these payments are due in regards to the first one, but for right now, I'm telling all of our clients to calculate the repatriation tax and try to at least make that initial installment payment plan by April 17th, 2018. Last question I'll talk about today is, what can I do if I don't believe that my earnings and profits have been calculated correctly over the last couple of years, or if I feel like they need to be recalculated? That's a great question. That's something that we're going to need more guidance from the IRS. Basically, in previous years, this hasn't been that big of a deal to make sure that your earnings and profits are extremely on point in regards to reporting them on Form 5471. I'm sure a lot of tax practitioners didn't make any adjustments or really look too deep into it when they're preparing Schedule J for Form 5471. So there may be some backward-looking fixes to make in regards to the earnings and profits, but you have to be very careful because Congress has basically indicated that if they're giving the IRS wide latitude, if they detect that you're playing with the earnings and profits to lower the repatriation tax in an improper manner, they can go back in and basically look through those adjustments. So be very careful on how you're calculating your earnings and profits, and if you are making any changes to your previous earnings and profits, you probably want to make sure you're doing that with a tax practitioner that understands and knows what they're doing in regards to that.